Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth right here in Singapore. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I've produced over 900 videos with more than 500,000 watch hours as of June 2025. I also focus on regional and global economic trends. If you're serious about taking your Singaporean investment journey to the next level, you'll want to hear this. Here's what's keeping most Singaporean investors awake at night. You're watching the STI reach incredible heights, with the index closing at 3,170 points on July 18th, 2025, showing strong year-to-date performance. But you're still stuck asking the same question. Which stocks should I actually buy? And more importantly, which analyst recommendations can you actually trust? The good news, I've cracked the code. After analyzing every major broker recommendation for June and July 2025, I've distilled this complex maze into 7 game-changing insights. But here's the twist. I'm not just regurgitating what analysts say. I'm giving you my unfiltered personal take on each recommendation. These insights could accelerate your wealth building in Singapore, whether you're investing through your CPF, SRS, or cash account. Today we'll cover 7 key areas. First, why I disagree with most DBS analyst ratings despite their market leadership. Second, why OCBC is my top banking pick when others are hesitant. Third, my surprising take on UOB's operational excellence. Fourth, why Singapore Exchange is my strongest conviction play. Fifth, the small cap construction boom I'm personally betting on. Sixth, my contrarian view on hospitality REITs. And seventh, the defensive play that could surprise everyone. Let's start with DBS, Singapore's banking giant that everyone loves to analyze, but few truly understand. DBS recently reported mixed results for the first quarter of 2025. The bank saw net profit decline by 2% year over year, primarily due to higher tax expenses from the implementation of the 15% global minimum tax rate. However, total income rose 6% to 5.91 billion Singapore dollars, driven by record fee income from their wealth management division. The bank maintains its quarterly dividend at 75 cents per share, which includes 60 cents ordinary dividend and 15 cents capital return dividend. While many analysts give DBS mixed ratings with accumulate and hold recommendations, I'm more cautious than most. Yes, DBS showed strong fee income growth, and their digital banking capabilities are impressive. But here's what analysts are missing. Margin compression is coming harder than anyone expects. DBS is like that successful businessman who owns multiple properties but suddenly faces higher taxes and rising costs. However, and this is crucial, DBS will benefit massively from wealth management flows. Their institutional capabilities position them perfectly to capture money from family offices flooding into Singapore. But my personal rating? Hold. Current valuations offer limited upside despite the strong fundamentals. Now let's talk about my favorite among the 3 banks, OCBC. This is where I strongly disagree with the cautious crowd. OCBC reported net profit of 1.88 billion Singapore dollars for the first quarter of 2025, which was 5% lower than a year ago, but 12% higher than the previous quarter. The bank demonstrated resilient performance with broad-based growth across fee, trading, and insurance income. Their cost-to-income ratio improved to 38.7%, with their non-performing loan ratio remaining sound at 0.9%. OCBC is like that conservative uncle who quietly built wealth through diversified investments. Their increased stake in Great Eastern Holdings to 93.72% isn't just numbers on a spreadsheet. It's defensive earnings insurance during economic storms. The insurance synergies provide a stable earnings stream that's particularly valuable during economic uncertainty. While analysts worry about the 5% profit decline, I see opportunity. That dividend yield is real money in your pocket every year. My only concern? Property exposure in Singapore and Malaysia. Their mortgage book means any significant property downturn could impact asset quality. But overall, this is my top banking pick for risk-adjusted returns. UOB tells a different story. While analysts give it accumulate ratings, I'm cautiously optimistic with important reservations. UOB posted 1.5 billion Singapore dollars in net profit for the first quarter of 2025, which was flat compared to the same period in 2024. However, their operating profit rose 7% year over year to 2.1 billion Singapore dollars, supported by record fee income of 694 million Singapore dollars, up 20%. The bank showed superior cost discipline with their cost-to-income ratio improving to 42.6%. UOB showed the strongest operational performance among the three major banks. Their cost control is impressive, with expenses declining while operating profit jumped significantly. But here's my concern that analysts are missing. Thailand concentration risk. Thailand represents a huge chunk of UOB's regional earnings, and their economic headwinds are real. However, UOB's wealth management growth in Singapore is underestimated. They're positioning perfectly for the family office boom that's happening in our city-state. For even more detailed charts, deeper dives into the data, and my complete written breakdown of today's topic, make sure to check out our Substack. The link is right there in the description. Now here's where I get really excited. Singapore Exchange. This is my strongest conviction play. SGX delivered exceptional performance with securities market turnover rising 28% year over year to 336.4 billion Singapore dollars for fiscal year 2025. The securities daily average value jumped 27% to 1.3 billion Singapore dollars, which represents a 4-year high. Derivatives volume also increased 17% to 315.8 million contracts. SGX isn't just an exchange. It's a regulatory protected monopoly that benefits every time someone trades. Think of SGX like owning the only casino in town. Whether people win or lose, you collect fees. The 28% increase in securities turnover validates my conviction about this company's structural advantages. What excites me most? SGX is becoming Southeast Asia's derivatives hub. This isn't just about local trading, it's about regional dominance. The government's support through various market development programs directly benefits SGX through increased trading activity. My rating? Strong buy. Food. Empire at current levels gets unanimous buy ratings from analysts, and I agree, but with important caveats. Their Southeast Asia expansion is solid, and recent strategic partnerships, including the collaboration with AirAsia Santan, indicate proactive management approach to business development. The company reported strong revenue growth, with particularly impressive performance in Southeast Asia and South Asia markets. But here's my warning: commodity price volatility. Coffee and sugar prices can destroy margins faster than revenue can grow. Their hedging strategies may not fully protect against sustained price increases. However, the AirAsia Santan partnership opens entirely new distribution channels that I'm excited about. This could accelerate brand recognition beyond current forecasts as aviation recovery continues. Still, the growth story is compelling. My rating? Buy, but monitor commodity exposure closely. Let's pivot to something most investors ignore. Construction small caps. Singapore's construction sector shows particular strength with demand trends that are encouraging for investors. I'm personally bullish on several construction names that have been identified by research houses. These companies are like hardware suppliers during a nationwide renovation boom. Everyone needs their services. BRC Asia benefits from Singapore's ongoing construction boom with strong project pipeline visibility. Hong Leong Asia provides exposure to both Singapore and Malaysia construction markets, offering geographic diversification. But remember, construction stocks are cyclical. Current valuations might not reflect economic slowdown risks if global conditions deteriorate. Here's my contrarian take on hospitality REITs. Capitaland Ascot Trust represents something special in this space. Capitaland Ascot Trust reported gross profit rising 4% year over year in the first quarter of 2025, driven by stronger performance from renovated properties and new acquisitions, including Japan hotels. 70% of profits came from stable income sources, with 30% from growth income sources, providing a balanced risk profile. The trust focuses on serviced residences, not traditional hotels. This means longer-term, more stable occupancy patterns compared to regular hotel REITs. Their recent strategic acquisitions in Japan show smart capital deployment during market opportunities. The distribution yield is attractive in today's interest rate environment, but I do worry about slower tourism recovery in some markets. Their geographic diversification means they're exposed to varying recovery speeds across different countries. My rating? Buy. This is a compelling hospitality recovery play with professional management and attractive yield characteristics. Finally, let's discuss the defensive play everyone overlooks. ComfortDelGro. ComfortDelGro posted a 19% rise in first quarter net profit to 48.3 million Singapore dollars, with revenue rising 16.4% year over year to 1.2 billion Singapore dollars. Overseas segments made up more than 50% of total revenues for the first time, showing successful geographic diversification beyond Singapore. ComfortDelGro is like that reliable taxi uncle who adapted to Grab and ride-sharing challenges. Their bus operations, overseas expansion, particularly in the UK market where contract renewals have improved margins, provide stability beyond their traditional taxi business. The profit growth shows management's ability to adapt and grow despite industry challenges. I agree with the buy rating analysts have given, but with important reservations. Long-term technology disruption is real. Autonomous vehicles will eventually impact this business model. However, for income-focused investors, especially those managing CPF funds or approaching retirement, this offers predictable cash flows that can weather economic storms. My rating? Buy, but monitor technology risks carefully. Now here's my comprehensive personal take after analyzing all these recommendations with the latest verified data. The Singapore market right now is experiencing something special. We're seeing genuine strength across multiple sectors, validated by real financial performance from these companies. This isn't just speculation or market euphoria. My three-tier strategy for Singapore investors remains focused and practical. Core tier should include OCBC Bank for reliable dividends and defensive characteristics. The insurance synergies and conservative approach provide stability that's valuable during uncertain times. Growth tier should feature Singapore Exchange with its record securities turnover and structural advantages as the region's key financial infrastructure. For the small cap tier, construction and recovery plays offer asymmetric upside potential, but require careful selection and risk management. The key insight from all this analysis is that the updated financials support selective optimism while respecting proper risk management principles. Singapore Exchange's 28% securities turnover growth proves the structural advantages I've been highlighting. ComfortDelGro's 19% profit growth demonstrates successful business adaptation. UOB's 7% operating profit growth shows operational excellence even in challenging conditions. For CPF investors, focus on dividend-paying stocks with proven track records and sustainable business models. For cash account investors, the growth themes we've discussed offer compelling upside potential, but always within proper position sizing and diversification frameworks. The Singapore market's performance reflects both cyclical recovery and structural improvements in our economy. While valuations have increased, selective opportunities remain across sectors for investors who focus on quality companies with strong fundamentals and clear competitive advantages. So, we've broken down Singapore's stock landscape with the latest verified data, and I've given you my personal take on every major recommendation. If you found this video helpful and want to seriously level up your investing game, please give it a like, share it with your friends, and subscribe to the Investing Iguana channel so you don't miss our next insights. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get my detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $1 a month, less than a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions delivered before the masses.